thoughts on 25 years to retirement are start now. There's no better time to get into the market than it is today. The numbers show the sooner you start, the better chance you have to compound over a longer period of time. It also gets you over the inertia of not investing. The longer you wait, the more inertia is going to work against you and encourage you not to start investing. You're always going to wait for, air quote, the perfect time to get into the market. There is no perfect time to get into the market. Your best bet is to start investing as soon as you can and start doing it any way that you feel will work best for you. And if ETFs are the way that you want to dip your toe in the water, by all means, dip your toe in the water. The sooner you can get started, the better off you're going to be in the long run. And 25 years is plenty of time to get where you want to go, as long as you start and start now. If you wait another 5 years, if you wait for the correction, whenever that may happen, yeah, the market analysts have been saying that, well, I don't know, probably for the last 10 years since we had our last bear market. They've been saying that we're going to have another one, and we will. But when is that going to happen? Nobody knows. And so I think the idea of waiting is not to your benefit. And I think the sooner that you can get started and start investing now and doing it, following all the things that we've talked about. You've listened to our podcast for over a year now, so you understand that we advocate for trying to find companies with a margin of safety, emphasis on the safety, finding good things that are stable, that will pay a dividend, that will be safe and secure. And those are going to be great investments during the ups and downs. And there's also this little thing called dollar cost averaging, which allows you to help smooth out any fluctuations that you will have when you buy stocks, whether it's an ETF or individual stocks. So there's lots of ways you can help mitigate some of the possible downturns. The other part of that is, let's say you buy in now, and a year from now, the market does take the downturn that you're afraid of. That just means that the great companies that you're buying now are now on sale. And who doesn't want to buy things on sale? We all do. And so that's when you can make the most money getting into the market. So I guess that's kind of my initial thought. I'd like to hear what you have to say, Mr. Andrew.
This idea that success in the market comes from the buy low, sell high idea is one of those that's just maybe a little misunderstood. And, when you're running a race or a marathon, it's not about, how did I look on mile 1 or mile 2? Like, nobody cares, right? Did you have a good pace along the entire way? And when it comes to investing, it's not about I invested and now I'm out. Because, okay, let's say you do sell early and you feel like you got a good profit. Well, now what? Investing is a lifelong thing. It's a journey. It's your path to financial freedom. And it's not like a game that you're trying to win. Hey, we won the championship, So that's where dollar cost averaging comes in, where you build this habit where you are investing a little bit every single month. And so when you spread that out, you don't have to worry about having this huge win or this huge period where you were the smartest person at the bottom and the smartest person at the top. That's kind of impossible to do. You have this habit and it's a part of you, and you're growing your money over time. And so I think looking at investing, you never want to put all your eggs in one basket. You never want to put, if we're talking about your entire life savings, you never want to put all of that in at once, because it really will matter when you buy. But if you talk about building an investing habit, starting from scratch, trying to build something for your future, that's going to take continuous steps. And it's not just one step, hey, we arrived, we won the game. It's step after step after step down the path to financial freedom. And so that as you take those steps, guess what? If the market goes down, sure, your steps from 2 months ago maybe are down in value, but now you have an opportunity to buy at an even better deal. And then on the flip side, they're always going to say that the market's expensive. That's just kind of, if they don't say that, they don't have anything to be on TV for, right?
Right.
So they need to say something controversial so that they will say that. And so, you might buy and it might get more expensive and get more expensive. But again, you're building that habit and you're getting this compounding to work for you. And really, at the end of the day, it's not even about where your money is going in and when it's coming out, but you're really partnering with the businesses you're buying. So if you're buying an ETF, you're partnering with those groups of businesses represented by the stocks in that ETF. Or if you're buying individual companies, And so you have to look at what are those companies that are going to be my partners, what are they giving me over the long term? And that's what they're going to do is they're going to work for you and help build your wealth and compound it and hopefully produce free cash flow that can be reinvested and create growth for everybody. And so that's kind of the mindset that needs to happen. That no, you're never going to get it perfect. And like so many other things, you just kind of have to get your hands dirty and just start and try, not worry too much about doing it all perfectly because nobody does it perfectly.
No, they don't. And I want to throw a few numbers at you to just kind of illustrate exactly what Andrew was talking about. So the arguably one of the greatest investors in the history of the stock market is Warren Buffett. And over a 50 plus year investing career, he has earned a compounded returns of 20% a year. But it hasn't been a steady 20% along the way. There have been some pretty serious ups and downs. So I'm going to read you just a 5 or 6 year snapshot here of some returns he got in the early 70s. So 1970, his returns were negative 4.6%. 1971, he earned 80.5%. In 72, he earned 8.1%. In 1973, negative 2.5%. 1974, negative 48.7%. And then the next year, 2.5%. So I guess my point with that is that I'm looking at his annual shareholder letter. At the first page of his annual shareholder letter, he shows the returns of Berkshire Hathaway for that particular year for every single year. And you can see at the end of the tally, it's a 20% return over all those years. But if you look at each individual year, there are some pretty wild swings. And you got to remember, he's not buying Tesla. He was buying Coca-Cola, American Express. These were investments that were maybe not the most glamorous and sexy, but I guess my point is that the returns that you can earn, you're going to have fluctuations. And just like Andrew was saying, those are steps that you can use to help you generate better returns, because you can bet your butt when Buffett was having a down year, he was buying more things at a cheaper price. And then when the stock market turned, which it always does, then he earned an 80% return in a year, or one year he earned 129% return. So it's just ridiculous numbers. But you also are going to have years where you're going to lose 20, 30, 40% on your portfolio. We all saw that in March of 2022 or 2020. We all saw the market turn very quickly and very sharply, and it was kind of scary. And I remember Andrew and I talking about it almost every day, that everything's red. It's everything's red. But it wasn't, neither one of us panicked, neither one of us sold out of the things that we owned, and we bought more things that were on discount and cheaper. And so that helped boost our returns when the market returned. And so again, these are all part of the mindset and all kinds of the mental gymnastics that you have to kind of put yourself through to keep yourself sane when you think about this, because you are going to see ups and downs, and it's part of investing in the market. And part of it is being calm and being rational and understanding that, unfortunately, Mr. Market, who is the one who generates all this, is not always going to be a sane, rational person. And you just have to kind of ignore that and stick to the basics and understand what it is you're buying and why you're buying it and what your end goal is. Because like Andrew said, nobody cares how you did in year 3 of a 25-year track record. All you care about is where you finish at the finish line. That's all that matters. It doesn't matter what happens in between, as long as you stay consistent and get to where you want to go. And that's, I think, the biggest thing you need to remember when you're thinking about this. So, Tim, I encourage you to dip your toes in, buy something tomorrow, right away. Doesn't matter what it is. One thing, just buy one thing. It's scary and it's super, but once you step off that ledge and you buy the one thing, then it's going to start to make a lot more sense. It's going to become a lot more real, and you're going to feel a lot more confident and a lot better about it. I know that's the way I felt. I think that's probably the way Andrew felt as well. But again, once you jump off that diving board and get in the water's warm, baby, and it'll make you feel better. So I guess that's my 2 cents.